So let's talk a little bit about where the market is year to date. When we look at this chart, you can see that the S&P 500 is actually up about 10% year to date. But the interesting thing is that with everything going on and the problems we've had in the bond market for the last couple of years that have really taken blended portfolios down, is the bond market is still showing about a 3% loss year to date. So if you have a blended portfolio, it's really kind of being a drag on that portfolio. Now we believe this will change when interest rates start to come down. We'll see those bond values start to go up and start to perform like they used to. But they're still showing a little bit of a negative trend right now year to date. When we look at the sectors, the components that make up the index, you can see here that technology, I want you to understand how to read this. Technology represents about 27.11% of the total value of the index. And that 27% is up 11.28% year to date. So technology is the largest sector in the index. And you can go down the list. Financial services represents almost 15% of the index. It's up 8%. Healthcare represents 11% of the index. It's up 4.5%. The rest of it, you can start seeing there's smaller portions of it. But frankly, what this is telling us when we look at the sectors is the market is having a broader impact. It's a broader increase in the market. It's not just technology like what happened in 2023. So that's a good sign. When we look at the economic indicators, we track these things every month. You can see currently that the May economic indicators, we've got 7 that are green, and then we have some yellow and red. How these are red is that the green means it's moving in a positive trend and it's actually improving the economy. If it's yellow, it's kind of in between. It's not necessarily good or bad. The trend is neutral. Red means the trend is bad. And obviously you can see that geopolitical risk, we know what's going on in the world, is bad, but so is equity market valuations. Because we've had this run up this year, Dan, in 2024, equity valuations are relatively high in relationship to expected earnings for the year. But we think this will be corrected down the road here. I like to also point out the chart on the right shows where we were at just back in January, what things looked like. There was nothing green. So you can see actually from an economic standpoint, the market or the economy is looking better as we have gone into this year. So those are very positive signs. If the economy is looking good, the markets are going to also be looking good. One of the sections, if you noticed on the previous slide that turned green, was consumer sentiment. Consumer sentiment is the section I just want to take a minute to talk about here. And this University of Michigan study that everybody follows, this is the index for how consumers feel about the economy. You can see that we actually hit an all-time low back in June of 2022. And everybody remembers that that was not a good year. The markets were down 20%. But from that point, people are feeling better and better about the economy moving forward. So they have it's getting back to that dotted line, which is an average feeling that the economy is doing well. So when you add all this up, what basically we're saying with the economy at this point of the year is that overall it is slowing. However, the leading economic indicators, which point to the next 6 to 12 months, are improving. That's showing an improving economy. So we believe that's all going to bode well for the stock market.